What if I told you that silver just broke its 1980 all-time high, and we're still in the early stages of what could be the biggest precious metals squeeze in history? In November 2025, silver surged past $58 per ounce, shattering records that had stood for 45 years. But unlike 1980, when two billionaires manipulated the market using leverage, what's coming is fundamentally different and potentially unstoppable. We're witnessing the convergence of four unprecedented forces. The fourth consecutive year of structural supply deficits, industrial demand hitting record highs above 700 million ounces, exchange inventories at multi-year lows, and millions of coordinated retail investors with instant access to physical markets. Today, we're breaking down exactly why this perfect storm is forming, what makes it different from the Hunt Brothers squeeze, and what it means for silver's future price discovery. The supply crisis. Let's start with the numbers that should alarm everyone watching the silver market. According to the Silver Institute's World Silver Survey 2025, global silver mine production in 2024 rose just 0.9% to 819.7 million ounces. Meanwhile, global silver demand reached 1.21 billion ounces, the second highest on record. Do the math, that's a deficit of approximately 390 million ounces in a single year. But here's what makes this truly unprecedented. This marks the fourth consecutive year of structural market deficit, with 2024's deficit at 182 million ounces. From 2021 through 2024, the cumulative deficit has drained nearly 800 million ounces from global stockpiles, equivalent to almost an entire year of world mine production. The Silver Institute projects the 2025 deficit will continue. That's not a temporary imbalance, that's a structural crisis. Why can't production increase to meet demand? Because approximately 80% of silver comes as a byproduct from lead, zinc, copper, and gold mining operations. You can't just mine more silver when it's not the primary economic target. Silver production is inherently constrained by the economics of other base metals. Mexico remained the leading silver producer in 2024, followed by China, Peru, Bolivia, and Chile. But even with recovered production from Mexico's Peñasquito mine, global output has essentially plateaued. Silver recycling did reach a 12-year high of 193.9 million ounces in 2024, driven by price-sensitive scrap from Western silverware as families melted heirlooms. But recycling represents only about 19% of total supply and cannot possibly fill the growing structural gap. First Majestic Silver CEO Keith Neumeyer emphasized this crisis. We're 6 years into this deficit. The deficit in 2024 looks like it's going to be bigger than 2023. And why is that? Because miners aren't producing enough silver for the needs of the human race. Industrial demand explosion. Now let's talk about where all this silver is going and why that demand is irreversible. Industrial demand rose 7% in 2024 to surpass 700 million ounces for the first time on record. This isn't speculative demand that can disappear overnight. This is structural demand for technologies that define our future. The solar photovoltaic sector alone is consuming massive quantities. Solar energy consumes more than 200 million ounces annually, representing about 20% of total silver demand. The Silver Institute reported a 158% increase in silver demand for solar panels from 2019 to 2023, with an additional 20% growth in 2024. The global solar industry grew 76% in 2023 and was forecasted to grow another 34% in 2024, with the sector growing at 27% annualized since 2015. China increased its solar capacity by 45% in 2024 alone. Despite manufacturers reducing silver content per panel through technological advances, total consumption keeps rising because installation volumes are skyrocketing. The University of New South Wales published a sobering study. The solar sector alone could deplete 85-98% of global silver reserves by 2050 if current growth trends continue. But solar is just one piece. The automotive sector is consuming record amounts for electric vehicle electronics, battery management systems, and charging infrastructure. Silver benefits from greater vehicle sophistication, rising electrification of powertrains, and ongoing investments in infrastructure such as charging stations. EVs contain up to twice as much silver as traditional vehicles. The 5G build-out requires silver for network equipment and semiconductors. The rapid adoption of AI technologies has resulted in growing needs for technological upgrades, replacements, and new infrastructure investment, all assisting silver demand. Silver's electrical conductivity is the highest of any metal at any temperature. There is no cost-effective substitute for most applications. When manufacturers need to conduct electricity efficiently in confined spaces, silver is often the only viable option. This creates an inflexible demand floor. Industrial users must buy silver regardless of price because their production lines depend on it. Unlike investment demand, which can disappear in bear markets, industrial demand is sticky and growing. The inventory collapse. Now, here's where the story gets truly alarming. Global exchange inventories have collapsed to levels not seen in over a decade. London silver inventory fell to nearly an all-time low of 827 million ounces in December 2024. This represents a massive drawdown from peak levels. But it gets worse. Of the 827 million ounces in London, reportedly 551 million ounces backs unsecured silver ETF holdings, leaving only a semi-opaque 276.5 million ounce float, with no way of knowing how much is actually available under the right market conditions. Meanwhile, COMEX deliverable registered silver inventory increased from 30 million ounces in summer 2023 to over 73 million ounces in early 2025. But here's the critical detail. The freely deliverable portion, registered, stood at approximately 193 million ounces in late 2025, representing about 36% of total COMEX inventories. That means the actual immediately available silver for futures contract delivery is far smaller than headline numbers suggest. A low registered buffer can lead to short-term bottlenecks during periods of increased demand and drive up risk premiums dramatically. Silver inventories on the LBMA and COMEX fell by 50% over 2023-2024 to 321 million ounces, the lowest levels since 2010. Without material supply growth, these inventory buffers that have bridged the supply-demand gap are being rapidly exhausted. Something remarkable happened in late 2025. COMEX, silver futures, began trading nearly 1 per ounce higher than London spot prices, an unusual divergence that signals physical tightness and delivery concerns. The government stockpiles that existed in 1980, gone. India's historical silver reserves, largely depleted. China's strategic inventories, dramatically reduced as the nation consumed record amounts for industrial applications. Unlike 1980, there are no massive above-ground stockpiles waiting to flood the market when prices spike. The ETF Lockup. Here's where market structure has fundamentally changed since 1980. As of December 2025, the iShares Silver Trust holds 508 million ounces of physical silver bullion, while the Sprott Physical Silver Trust holds 191.12 million ounces. The Aberdeen Standard Physical Silver Shares ETF holds another 45 million ounces. Combined with other silver-backed ETFs globally, over 700 million ounces of physical silver now sits in vaults backing tradable securities. That's more than 85% of annual global mine production permanently removed from industrial supply chains. In the first half of 2025 alone, silver ETFs saw net inflows of 95 million ounces. Bloomberg data showed silver-backed ETFs added about 200 tons in early December 2025, lifting total holdings to the highest level since 2022. Here's the critical difference from 1980. These are not leveraged positions that can be forced to liquidate. These are physical holdings that back tradable securities. The silver sitting in ETF vaults does not flow back into the market unless ETF investors sell en masse, and even then, it's more likely to be purchased by other investors than returned to industrial use. ETFs have fundamentally changed silver's market structure. They've created a one-way valve where metal flows in during bull markets, but does not necessarily flow out during corrections. Investors now have a convenient way to hold physical silver exposure without storage concerns, permanently removing hundreds of millions of ounces from the available supply pool. Think about that. 700 million ounces locked in ETFs, plus another 300 or 400 million ounces held by central banks and institutional investors, plus millions of retail investors holding physical coins and bars. That's well over 1 billion ounces, more than a full year of mine production. That's unlikely to return to the market even at higher prices. The Hunt brothers. What actually happened to understand why what's coming will be different, we need to understand what happened in 1980. The Hunt brothers, Nelson Bunker and William Herbert, began accumulating silver in the early 1970s, when it traded around $2 per ounce. After inheriting billions from their oil tycoon father in 1974, they dramatically accelerated their buying. By late 1979, the Hunts controlled an estimated 100 million ounces of physical silver, roughly one-third of the entire privately held global supply. When they took delivery rather than rolling futures contracts, they created an artificial shortage. Silver rocketed from $6 in early 1979 to $49.45 per ounce on January 18, 1980. At peak, the Hunt brothers' silver holdings were valued at approximately $4.5 billion. Industrial users were crushed. Kodak's costs skyrocketed. Tiffany & Co. took out a full-page ad in the New York Times condemning the Hunts for unconscionable hoarding. People melted down family heirlooms. Silver theft exploded nationwide. But here's the key. The Hunt's entire position was built on massive leverage, borrowed money through margin accounts. When COMEX changed the rules on January 7, 1980, adopting Silver Rule 7 that restricted margin purchases, the squeeze immediately reversed. The Chicago Board of Trade, suspended new silver futures contracts on January 21st. Prices began falling. As silver dropped, the Hunts faced devastating margin calls, demands to post more capital to cover their leveraged positions. On March 27, 1980, Silver Thursday, the Hunts missed a $100 million margin call. Silver crashed 50% in a single day. Within weeks, it would fall below $11. The Hunts' liabilities reached $2.5 billion against assets of only $1.5 billion. A consortium of banks provided a $1.1 billion bailout to prevent systemic collapse. The brothers were later convicted of market manipulation, fined $10 million each, banned from commodity trading, and declared bankruptcy. By 1982, silver had collapsed 90% to $4.90 per ounce. The Hunt squeeze was ultimately broken because it was driven by a small group using extreme leverage, vulnerable to rule changes by exchanges based on speculation rather than fundamental demand, easily reversed once the leverage was forcibly unwound. Why 2025, 2026 is different. Now let me explain why what's happening now is fundamentally different, and why it can't be broken the same way. No leverage vulnerability. Today's silver accumulation isn't built on borrowed money. ETFs hold physical metal. Retail investors buy coins and bars with cash. There's no massive leveraged position that exchanges can collapse by changing margin rules. Millions of participants, not two. Unlike 1980, this isn't driven by two billionaires. Millions of retail investors coordinate buying efforts through social media and online forums, making market manipulation by rule changes nearly impossible. You can't force millions of people holding physical coins to sell. Real industrial shortage. In 1980, industrial demand was modest and could be met through recycling and inventory drawdown. Today, the world used 1.3 billion ounces of silver in 2024 for industrial inputs, investment, and net silver ETF inflows compared to just over 1 billion ounces supplied by new mining metals and recycled silver. Industrial users must keep buying regardless of price. No government stockpiles. In 1980, governments flooded the market with strategic reserves. Today, those reserves are exhausted. There's no cavalry coming to save stressed industrial users. Inventory depletion. Without material supply growth, inventory buffers that have bridged the supply-demand gap may soon be exhausted, forcing the market into a true physical shortage where paper contracts can't be settled with actual metal. The paper market will break. The current COMEX system, where open interest dramatically exceeds available physical supply, can only function when participants trust they can get delivery. As physical tightness increases and delivery demands surge, the paper pricing system will break down, creating a permanent divergence between paper and physical prices. Here's what makes this inevitable. The gold-silver ratio currently sits around 86.1, down from over 100.1 earlier in 2025, but still historically high. The historical average is 4060.1. If silver simply returns to its historical relationship with gold, we're looking at prices well above $50, potentially $60 to even $70 per ounce, even without a squeeze event. But a squeeze event is coming. The trigger could be a major mine disruption, industrial panic buying as users realize inventories are critically low, another coordinated retail squeeze, a geopolitical crisis disrupting supply chains, or a currency crisis driving safe haven demand. When it happens, the price will spike violently, potentially to $100, $150, or even higher, according to some analysts. Bank of America forecasts a high of $65 per ounce and an average of $56.25 per ounce for 2026. Some independent analysts, like Keith Neumeyer, predict prices reaching $100 to $130 per ounce. Unlike 1980, when the crash returned silver to $4, the post-squeeze price won't return to current levels because the fundamental shortage remains. The new floor will be dramatically higher, permanently resetting silver's price discovery based on actual supply-demand fundamentals rather than paper market manipulation. We are witnessing the setup for the most significant silver market event since price discovery began, 4 consecutive years of structural deficits. Record industrial demand that cannot be substituted. Inventory levels at decade lows, over 700 million ounces locked in ETFs, and millions of informed retail investors who understand the fundamentals. The question isn't if this powder keg will ignite, it's when. Unlike the Hunt brothers' squeeze, which was artificial and temporary, what's coming is real, structural, and permanent. When silver breaks free from paper market suppression and finds its true price based on physical supply and demand, we'll look back at 2025's $58 all-time high as just the beginning. The perfect storm is here. Are you prepared?